Hello, good afternoon, everyone. I welcome you all on the virtual CPE meeting on 360-degree view of forensic accounting and investigation and expanding globally by overseas direct investment and applicable FEMA regulation, organized by Committee on Economic Commercial Laws and Economic Advisory of ICAI. I hereby request the Chairman, CA Dr. Rajkumar Adukia ji, Chairman of CELE, CEA Committee, CPE Committee, and Convener of Publication and ES Directorate.
Chairman sir will join in a while. So in the meanwhile, you can introduce the speaker and continue with the program. I guess there is some connection issue with Jaideep sir. Can you hear Jaideep sir?
Not yet.
Okay, sir. Then, sir, I'll introduce you. CA Jyot Pakshi ji is the author of the book New Era of Forensic Accounting, which is published by the Bharat Law House. He is an associate member of the Institute of Chartered Accountants of India. He has ventured into the forensic era from very early post-qualification days, and he has undertaken the certificate course offered by ICAI in Forensic Accounting and Fraud Detection. He has been an avid learner. His core competencies are in the field of business consultancy and risk advisory domain. So I invite you, sir, to share your presentation and give us your expert comments on the topic.
Sure. Can a company cheat? Is it not the people within the organizations who cheat? Do we all not have aspirations to win hook or by crook? There are a lot of pressures, lot of factors and forms of pressure surrounding human beings. Lot of options to rationalize. 7-time winner of the toughest cycling race in the earth and a cancer survivor could not refrain from cheating. Organizations lose up to 5% of their revenue every year on account of fraud, median of which comes up to a whooping number of $1.5 million per case. Occupational frauds take up to 14 months to be detected. More surprisingly, financial statement frauds take up to 24 months until they are detected. With these thoughts, with these numbers, with these points as a background and context, I welcome all of you where I justify having such a topic, having such a session, and how and why these things are now becoming the need of an hour. I once again thank Shalini ji for giving a very kind introduction. I thank Dr. Rajkumar Adukia sir for having me, the Committee on Economic Commercial Laws and Economic Advisory for having me here. So with this note, let us now deep dive into the topic and take forward the discussion, where the first thing that we do is have some perspective on the topic. The topic being today before we go into the agenda of the session, let us just have a perspective of what is forensic accounting. In the image, we can see there could be different perspectives when the same thing is looked at from different sides. Correct? As they say, the number 6 is number 6 from one side and number 9 from the other side. In a similar way, there is an image showing the same thing, that when a certain thing is looked at from different angles, there could be different interpretations, different perspective. That is what forensic accounting requires. There needs to be a culmination of having a bird's eye view and an ant's eye view, where we look at things from both angles, that is a broader sense as well as a very minute detail to those things. Taking forward the analogy, can we see this image? In the image, now we are moving to a different analogy to say that apart from looking at a certain thing from different angles and having different perspective, can we look at the same thing from same angle and have different perspectives? Oh yes. Again, this is what is forensic accounting. To have this kind of analysis, this kind of a mindset, this kind of a minute eye to detail, combined with common sense, to become a forensic professional, to become an investigating professional. To give one quick example, we all understand financial statements, we all understand profit and loss account. We do a company health check saying that a company is making profit before tax. And we are happy to say that, yeah, the company is doing well. What if the company is a manufacturing industry and the cash flow from operating activities is negative? What does that indicate? That probably the profit before tax is due to some other reason, maybe a sale of investment. And then if we look into the cash flow from investing activities, we understand there is a profit on sale of an asset. That, my dear friends, is something with respect to having perspective. We need to connect the dots. We need to bring together those lost pieces of paper and join to make a clearer vision, make a clearer picture of how things are. Correct. So on that note, we would be answering the WH questions basically in our today's discussion. With respect to forensic accounting and investigation, we would be understanding the context and scenario. We've already started that why this topic, what are the things moving around this topic, what are the other agencies doing in order to make this mandatory aspect, reporting aspect, why this, correct? So we will try to understand that, then go into the most important thing, what could be and what would be rather the approach, where we will discuss two things: conventional approach as well as non-conventional approach. We will try to this will be the heart of the discussion, where we'll deep dive into what could be the approach, in what kind of an assignment, how things will differ, how to actually go about it, because the topic is to have a broader understanding of the whole subject, whole topic in 1 hour. So understanding the importance being one, then how to go about it, what are the upcoming forensic accounting and investigation standards, and then of course what are the opportunities, where we will try to interact in some manner and then try to understand that if there are these lot of movement across the industry, across the regulators, across the agencies, then what are the opportunities for us chartered accountants in this field? Having said that, primary understanding of difference between the two terms, right? So that would be basically forensic accounting is nothing but gathering evidence which can be proved in the court of law. It is an exercise which involves arts, commerce, and science, all three of it. Of course, now we have standards, but the approach would not have a standard approach. It would depend upon the case. It would depend upon the circumstances. So there is no 1 + 1 only which equals to 2. But there would have to create a lot of hypotheses. lot of assumptions, testing the theories, and at the end of the day, gathering evidence in a scientific manner so that it can be proved in the court of law. How does investigation differ? Investigation differs on very important aspect of an intent. It differs on the aspect of the people angle, where there is allegation, where there is a lot of impact with respect to involvement of someone and trying to identify the perpetrator of fraud, trying to understand and gather evidence around the intent is when it becomes more of an investigation. Like, for example, expert witness would come under forensic accounting rather than investigation, where regulatory investigations would hardcore be to understand the intent and take further action with respect to more on the criminal side of it. So, with this note, we at least have a fair understanding of what these two terms are and how do they differ. Okay. So going further, these are the things that I could briefly also narrate in the first initial discussion. But other than that, these are some numbers around forensic accounting investigation, where it says that one of the most common source to identify a fraud, to identify an irregularity or an anomaly is a tip. As we all know, whistleblowers. The lack of internal controls and override of existing internal controls, those contribute more than 20% to the occupational frauds. Which is one of those departments which is most vulnerable, that is sales department. So these are some numbers from the ACFE survey, global survey. Moving on, okay, so as we said, this is the first part of our discussion where we are about to understand and complete our understanding on the context, the importance. These are few very important developments. We might as well know, or if not, just to summarize, that the SEBI has made disclosure requirements on forensic audits in October 2020. It is forming a new department to keep a check on promoters' fraud. FCRA is entrusting responsibilities. The Institute's Forensic Accounting and Investigation Standards are going to be adopted by MCA and IBBI. The very fact that accounting software requires to maintain an audit trail itself is a trigger point. Itself explains the need of forensic accounting and investigation because of the things that we discussed in the first few minutes. The psychology, human tendency makes fraud a pervasive factor. And that is where these things are growing. That is where regulators are recognizing. That is where developments are happening across multiple provisions. With this, our mother institute has come up with forensic accounting and investigation standards. The standards are broken into 6 aspects, 6 areas, being the key concepts. How to actually go about the engagement, what is to be taken care of when we talk about the scope of work, when we talk about the engagement letter, how to execute the assignment, what are the evidences, what are the documentation to be maintained, the specialized areas, related party transactions, loans, borrowings, how to actually maintain at least a good extent of standardized format where we at least ensure that maximum boxes are ticked from us forensic accountants and investigation professionals to maintain the standards when we go about the things. How to report, to give an opinion or not. Are we supposed to give evidence? How staunch the evidence? How to maintain the chain of custody? How to maintain the trail of documentation? You know, and a couple of examples, FAIS 140 talking about applying hypothesis. We think a lot, but now with the standards, we need to document this before we go into any engagement. Let us take an example. Let us take an example to say that we have been appointed to investigate into an occupational fraud in the procurement department to see if there is any favoritism, any favor, any collusion of someone in the procurement department with the vendors. What are the different types of hypotheses? What are the different types of theories that we as forensic accountants would form and then test it? You know, making a note of it, we would quickly jot them down, saying that could it be probably somewhere to do with the tender mechanism, the quotes which are being called for, what the timing of the quotes which are being received. There are certain criteria specifically included in the quotes. Is there some cartel formed between the people who are giving the quotes? Are there some technical requirements from the vendors which is specifically present in only few of those? Is there a trend with respect to the people who are not submitting a quote? What are these things? We would prepare a list of these things and then test it. That is this happening? No, yes, and accordingly move. Similar way with respect to the evidence and documentation, the bank statements, the financial statements, the other reports, the logs, the chain of custody. All of these require to be maintained with thorough professionalism in order to make sure that the hard work done by the forensic accountants does not go into vain when the report has to stand the test of the time in the court of law. Because at that time, a smallest evidence with regard to casual approach, with regard to loose documentation, would only hamper the case. So, all in all, having said all of this, I'm sure by now we are fully aware, or we are more aware of the fact that, correct, forensic accounting, investigation, it's just the beginning of all of this. So with this note, let us now discuss the second phase, and as I had narrated, the heart of the discussion today, being the practical approach. You know, we've noted 6 things on the screen. We will take practical examples also onto the approach, but a small disclaimer to say that each of these approaches or each of these points under the approach are so exhaustive, so elaborate, that it would take a 2-3 hour session for discussion. But before that, let us take one by one. So first, being comprehensive review of financial statements and performing financial analysis. What does this mean? Can we do a trend analysis? Can we do a vertical and horizontal analysis? Can we do a qualitative vis-a-vis quantitative analysis? Or with the financial statement? So the numbers, financial numbers with the non-financial numbers. Very classic example could be number of employees and the employee cost. So if there is some trend, there is some pattern, through the financial analysis, can we compare that with non-financial data, qualitative data, and then come up with unique hypothesis, unique theories of what could the possible modus operandi be. Business intelligence, what does that mean? Business intelligence is public domain searches to understand if there is some entity involved in some transaction. Can we go on to see the financial statements of that entity? Can we go on to see the business presence of that entity, the technical capabilities? Can we go on to the Google satellite view and check whether it is actually present? Can we actually go in to see what are the financial numbers? Is there any public domain adverse news? Is there any politically exposed person? How far is the vulnerability of a cartel being formed, of an entity not being a related party confined to the definitions of the rules and regulations across the various provisions, but otherwise? Is someone somewhere very closely associated, but not a family member, not a relative? Can there be a via connection identified? Can there be some financial records? Can there be some data with respect to property mortgaged, securities given, hypothecation, identified from business intelligence? Can there be something to do with our vehicle records? Can there be some evidence with respect to the personal identification numbers on the public domain? So we have to use these facts and evidences to identify unique data sets and apply our intelligence to test that data. With the help of number 1 and number 2 is when we'll be able to arrive at documentation review and transaction testing in most of the cases. Let's say our financial statements show that the loans which are being received by an entity are being repaid before the maturity period, and we are so far so good. We don't treat that transaction as a risky transaction or a vulnerable transaction. And then what happens is, during our business intelligence, we understand that the entities or the organizations through which the loans are being received are probably somewhere may be connected. And then during transaction testing, if we go on to check the documentation, the bank statements, the fund trail, is only when we realize that a single loan was actually received, that was probably not utilized for the purpose for which it was extended. And ever since then, only there has been an evergreening of loans. So what happens is, there is no default actually. The things are being repaid before the maturity, but it is only from which source are we getting the repayment? Is through a new loan, and not out of the profits, not out of the cash flows of the company. How would we identify all of this? Only when we go about the investigation, go about the forensic accounting engagement in a structured manner. Then what next? What about digital evidence? There are a lot of engagements where this kind of exercises are also to be undertaken with respect to digital evidence recovery, review. A very interesting case of the then president of Pakistan. A document was identified purported to be of 2006, having the font Calibri. Only later, through digital evidence, it was identified that that document, which was having the date of 2006 with the font Calibri, actually Microsoft had not launched for commercial use the font Calibri in 2006. how could there be a font which is not open for commercial use on a document on that date? A document which is created by someone is easily identifiable. A document, a vendor sending a quote, but the document has been created by someone within the company. The date of the document is somewhere or the other prior to the date in question. After the date in question, can we, through digital evidence, combine number one, number two, number three, and gather some interesting evidences, is what we understand through this practical approach. So, having said this, then comes the interview, the interrogation part. This again is a unique understanding of behavioral science, psychology, human tendency, understanding the gestures, understanding the haptics, the body language. Someone answering in a certain manner to certain questions, asking questions that we know answer of, asking some open-ended questions, asking some admission-seeking questions, rationalizing with the other person to probably gather the information, asking close-ended questions, asking a yes or no question, asking them to open up with their side of the story. Admission seeking interviews, guilt seeking interviews, cross examining. We've been seeing movies like Drishyam, how interviews and interrogation are being used to gather the information. So based on these five things is when we come up with reporting. And reporting again is very specialized job as forensic accountants and investigating professionals, because we need to, in one of the cases is where court of law is questioning that where is the hypothesis being formed, where have you actually tested that you have ruled out the possibility of a certain transaction to be of a certain nature, and now you are only giving evidence for it to be of a certain nature. So if we have actually formed those hypotheses, narrated them in the form of a report, given hierarchies, given tables, given relationships, given the actual procedures performed in detail, given the evidence for each and every identified observation, is when it would make a complete report which would be able to stand the test of the time in the court of law. So, depending upon an engagement, any 2, 3, 4 of these 6 steps would come into play for the engagement. So, having said this, this is what is a conventional practical approach. These are the basic fundamental steps involved in any investigation, in any forensic accounting case. Depending upon the scope of work, things would differ, but broadly it would fall under any of these buckets. Now I would like to quickly request the participants if we can go on to this website www.menti.com and use the code 84748833. I'll also switch on to that website. Can we go to the website menti.com and please use this code which I have already shared, 84748833, and punch in the answers just to make sure that we are trying to interact, we are trying to understand. Can we and answer the question to what? Do we know of certain techniques, unique tests that we can apply in forensic assignment? I hope everyone is able to log into, I mean, it's a very easy process. Just go to www.menti.com and use the code 8474 8833. I hope we are able to punch in some answers. Can we get some answers? If we have some answers, we will be able to see it online. So I just hope if we have some answers, then it will make the further discussion very easy, very interactive, where I'll be able to give some unique references, correlate the points that we are able to have on the screen. Do we have, we'll wait for 5 more seconds, 10 more seconds to understand if we have something from the participants. Yeah, that's good. We have analysis of financials, digital evidence review. Okay, do we have any other answers? We have one participant who's responded. We can wait for a few more seconds now that someone is okay. Microsoft Excel, unique. Okay, I'm very happy we have a lot of answers now. Audit, substantive techniques, analytical techniques, interview. That's good. Document review. Okay. Okay, the relevant ones are the ones I'm picking. Test control, yeah, correct. Test control. Understanding the process. Examination of documents. Interview, correct. We are talking about some unique tests. We are now talking about some non-conventional techniques. Okay, what are the new ones coming in? Cross question, correct. Questionable, okay. Review, okay. Business intelligence, correct. Aging analysis, very right. Okay. Computer assisted audit technique, someone is meaning thereby, which is very correct, very relevant. Computer assisted audit techniques, we will actually be looking at that coming up. Relative, so I understand related party transactions. That's great. So I'm happy we've had 28 responses. I'll stop this. I'll stop right here, and now we go back to the presentation, business walkthrough. Thank you so much, everyone. Now let's. Okay, red flags identified. I'm so happy there are participants participating. But thank you so much. So, having said this, now let's actually go into the points. Just a second. I'll probably close the presentation. Yeah. Yeah. So having said that, all of those things definitely are going to help us in this forward going discussion. What are the unconventional techniques that we are talking about? Someone had written trust, very important. I am saying in another way, it is distrusting the obvious. Why do we as forensic accountants are not supposed to trust anything? Why do we trust any document which is given to us? The bank statements, the financial statements. There are certain things. Access to the accounting software, ERP, MIS and existing reports, invoices, agreements, authorities versus board resolutions. So why do we have to just trust the transaction? If there is a dividend, there are two examples that we take. The profit in the financial statement aspect we've already covered in the previous discussion, but let's assume there is a dividend paid by a subsidiary company to the holding company, and we are, as forensic accountants, not really bothered because it's an income, for the holding company, and we are like, okay, what's in it? Can we further go and test and actually see the fund movement? It's only when, through documentation review, through fund movement, we will be able to identify. And this has been in one of the practical cases, that what has happened is the holding company is extending a loan. The holding company is making payment against a fictitious purchase to the subsidiary company. The investors and promoters of the holding company are happy that they've received dividends. The stakeholders, the financial institutions are happy that the subsidiary company is doing well. But rather, it is only through those extended loans, it is only through the fictitious payments made, is where the dividend is being sourced by the amount for the dividend is being sourced by the subsidiary company, and only then it is coming into the books of the holding company. So why to trust any transaction? We need to apply our analytical skills. So these are probably not skills, or these are probably not the point where we talk about a certain approach, but a shift in the mindset, shift to understand the concept of inverse logic itself. Very basic thing. Now a lot of us know already that if there is a certain quantity of stock in the books of the accounts as on 31st of March, does the entity have enough storage capacity? Does the entity have enough capacity in the warehouse, in the plant, in the transit, to even actually store that much of stock? While we actually look at the vouchers, is the vehicle a petrol vehicle? Is the vehicle consuming diesel? What are the vouchers? In the case of identifying a ghost employee, very, very critical. And see, at the end of the day, there is someone perpetrating a fraud, and there would always be some evidence. Assume there is a ghost employee, or assume there are ghost employees. There would be some system in place whereby the attendance record will get punched automatically. Otherwise, it's very easy to identify. So then what next? Can we now apply the inverse logic over here to understand that there could be some trend, there could be some pattern, because now it's a system driven punching. There is no actual employees, so there could be some trend or pattern identified. Because to do the punching, there is some system, so there would be some pattern. Same arrival time, same departure time, not being on leaves, and very importantly, assume there is an online seminar, assume there is a physical seminar, assume there is a offsite, assume there is some unusual, rather extraordinary event in that organization. There would be attendance records. Just recollect the times when there are seminars and stuff like that in physical, where attendance is taken. At that time, probably manually to punch the names of so many ghost employees would become difficult. So we have to identify some logic, play inverse of what things could not be. Very classic case of last year was being discussed is during the lockdown in 2020, there could not be certain things happening between the 24th of March 2020 and 31st of March 2020. There could not be certain things happening where there is a lockdown. If there is a Sunday, if there is a weekly off, if there is some default in the capacity, if there is a default in the quality of certain product, and there are a lot of rejections, material return in a certain area, the logic says that if the batch is there a similar thing observed in the complete batch? You have to apply inverse logic. There are few Birbal techniques, as they call it in forensic accounting, to trap. A very short anecdote could be there would be some irregularity in an entity where a lot of cash is being deposited in multiple boxes, and the auditor calls a meeting to say that now I will be introducing 500 notes, 500 rupee notes into the cash box with a cross sign. Okay. And the box from which those 500 rupee notes disappear would be the box where there is some irregularity in the cash. Knowing of this, the supervisors knew all of this, that there would be a particular day on which this exercise is going to happen. And what happens is the auditor does not put the 500 rupee note and does nothing rather, and out of panic of the individual undertaking the irregularity, does not find the 500 rupee note in the box, and out of panic adds a 500 rupee note with a cross sign. That helps the auditor to understand that actually the auditor had not put in anything, but the person perpetrating the fraud out of panic has added a note. And that is where there was some irregularity going on. So these are non-conventional techniques which are being used. There are these tiger team tests, just 31st March is approaching. We would be undertaking inventory verification, physical inventory verification. A lot of chartered accountants will be doing this. Can we also do surprise checks? We've already informed them. That is where they already know that there is a team going to come. A very practical example that had happened is, there is a store. There are a lot of remote locations where a lot of goods are being stored. So when the auditor has planned a schedule, it is now being told that auditor will visit so-and-so store, so-and-so warehouse at so-and-so time. And what the perpetrators of fraud are doing is, the material is also moving with the auditor. When the auditor is moving from store A to store B, the material also is parallelly moving from store A to store B. Only when the auditor surprises the entity by saying that we've forgotten something and have to go to store A, is when they realize that store A does not have the kind of goods that they had when they were in the physical visit. So walkthrough trials, test of internal controls is someone said in our question interaction, correct? So how to test those controls is this way. Time and space dimension test. We saw one of those examples of physical verification of inventory, warehouse space and all. Similarly, in SAP, there is a concept of posting date, creation date, document date. Can we check those? When are those being entered? What is the time at which a certain entry is entered? What is the kind of quantity being dispatched versus the mode of transport? Certain things cannot take place at certain times. Certain things cannot take place in a certain vehicle. How could 1 ton of cement go into a Chota Hathi, or as they call it, Tata Ace? We've identified things. We've saw the example of business intelligence, where we are trying to say that can we map the records of the vehicle with the public domain? And then we are able to identify very shocking results. These are time and space dimension tests. Going further, very, very critical Benford's law. What does this law say? This law says that there is a certain probability of the numbers starting with the digit 1, digit 2, digit 3 in a set of naturally occurring numbers. Of course, not, the employee IDs or the serial number kind of thing, PO number kind of thing, but in the amounts, in the quantity, in the weights. Those are naturally set of occurring numbers. There is a certain probability assigned to digit 1, to digit 2, number starting with digit 1, number starting with digit 2. Can we try and test those? I am not saying that all of these tests will give us short issue with respect to some fraud, but we will identify new kind of theories. In one of the case, what happened is, of course, we will have some time for questions. Correct. So, in a set of naturally occurring numbers, what happens is, if we saw the probability, what happened was the most numbers were starting with the digit 3, defeating the Benford's law. Then we went into the detail to understand that only it was because a specific quantity was being ordered is where the billing was of a certain amount, and that is why that was happening. So we need to test it. Where? In the journal entries, in the purchase orders, in the account. Are there round figure transactions in the inventory prices? So this is one of those things. This relative size factor theory, the same test theory. There is a certain transaction with a certain party, okay, of let's say 50 lakhs. Otherwise, all the transactions with that said party are within the range of 30, 40, 50 lakhs. And then there is one transaction with that party of, let's say, 70 crores, 80 crores. The difference between the highest and the second highest transaction is not something usual. The same test in a vendor master. Can there be multiple email addresses, same email addresses for multiple vendors, same mobile numbers for multiple different named vendors? So having discussed all of this, these were the kind of non-conventional techniques that we discussed. Now, as we go on to the last part of opportunities, may I kindly request the participants to again go to menti.com, use the same code 84748833. We'll wrap it up in next 5 minutes at max, so we have some time for the questions. Can we go to menti.com and have one more question? I have one more question for all of us, again, to understand and try and give some additional points for opportunities. So the question is, what are the opportunities that we know of in forensic accounting and investigation? The kind of assignments that we can do, the kind of services we can render, the places from where we can get work. So any of these are most welcome as an answer to this question. The code, now I believe a lot of us are accustomed and used to this. So 84748833. I'll refresh it so that we have. Can we start having some answers so that we can quickly discuss that what are the actual opportunities that we would have? Can we have few answers? I'll just make this live. I think we have debtors and creditors. we would check for, we would apply forensic tests there. Okay. Any other points, any other things that we could do, and what are the kind of opportunities that we could have? Vigilance, correct. Vigilance is one thing. Anything else? We'll try to quickly wrap up to have some time for the questions. To the questions, I'll share the results of this. Okay, resolution professional, investigation, debtors and creditors. Okay, the large accounting firms, consulting firms, correct, on behalf of government, correct. So, correct. So, okay. So, having said that, let us now discuss what do I have for us in terms of the opportunities. So there are opportunities in the field of practice, there are opportunities in the field of employment and academics. So these are the three buckets under which these are the three umbrellas under which rather I would put the kind of opportunities that we have, right? And under that, it is very important to understand when especially in the area of practice, there are further two things. One is proactive forensics and one is reactive forensics. Proactive, where we do the kind of fraud risk assessment, fraud risk management, pre-onboarding vendor diligence, pre-onboarding employee diligence, kind of an assignment, kind of a support risk advisory service. And reactive is when we do a lot of things in the hindsight for, let's say, someone said resolution professionals, someone said investigations. When we have a lot of answers. So SEBI, RBI, tender investigation, to register with IBA, very right, is the go-to thing when we are into practice. Banks, very rightly said, across banks, CBI, police, data analysis. So yes, having discussed all of this, I will share what do I have in this aspect. It could be with respect to governance. It could be with respect to ethics and integrity. Is where you support the organizations, enhance these mechanisms. The regulators, as a lot of us are saying, the CBI, ED, police, SFIO, MCA, economic offenses wing. These are the opportunities. Professionals' perspective, there are a lot of opportunities. Can't we apply these theories and tests in our internal audits, in our statutory audits, and use this as a value-added tool? So bank audits, now that the season is approaching. So diligence, banks, as someone already said, fraud risk assessment, as I said, digital evidence, as someone said, anti-money laundering, anti-bribery, anti-corruption reviews, supporting the corporates from a proactive side, ethics, as I said. So there are a lot of opportunities in employment, in academics, in practice. And I'm very sure that the times to come for forensic professionals is very bright. Having said that, I once again thank the committee, the chairman of the committee, Adukya sir, and all of you for actively participating in the questions that we had and making it very interesting and interactive for me. Shalini ji and I think Jaideep sir, we can have questions now.
It is a wonderful session, and I am dropping the questions from participant in your chat box.
Sure.
Yes, sir. I have dropped.
First question. Okay. What are the ratios with which we can identify fraud by analyzing? Okay, so very good question. So we will have to undertake multiple ratio analysis. Can we do certain ratio analysis from a year on year component to component. There is no one size fits all kind of a ratio. But all our liquidity ratios, our solvency ratios, our profitability ratio would be some trend in somewhere. As I'm repeatedly saying, there are no one size fits all. But the high risk areas, or where you see a lot of deviations, can you test asset turnover ratio? Can you see debtors turnover ratio? We will have to prepare probably an exhaustive list of ratios that we can test. And wherever there are unusual trends, deviations, there is a 5-factor test, there is a 7-factor test. Those are established tests, which are, I mean, those formulas and all are available. Either you can contact me as well in case if you are not able to find it. But the 5-factor, 7-factor tests go on. They are scientifically proven in a lot of cases, so we can try them. They say that those help in identifying financial statement irregularities to a good extent. So if there is anything on that further, I'll be happy to answer. But there is no one size fits all. We have to prepare an exhaustive list and test case by case. How to draft forensic audit and fraud audit report? Please give some standard main points. So the report has to have a head and tail, as we say. What is the context of that report? Who is the agency appointing us? Which is the entity which is appointing us? Why have we been appointed? What was our scope of work? All of this forms the head of the report. Then comes what was our scope of work and what was the background of that entity. That could be the second part of it. The third part of it could be what are the procedures performed. So the procedures performed have, as we discussed, the procedures performed need to be discussed in utmost elaborate manner. The hypothesis, the documentation undertaken, the public domain searches which are done, the financial analysis which is done, what kind of documents were required for, what were requested for, what were provided, what were not provided. So if there is a lot of discrepancy with respect to data, probably we can include that section also in the report to say data information requirement status, something like that. So that could be the second and third part of it. Then we would go into any observation that we have. Now, again, this is the phase where there is again no one size fits all concept, but there are few things, as I said, any transaction, see, 4 to 5 things have to be there. Now, this is not from a report perspective, standardized report perspective, but an observation perspective, in depth. The dates need to be there. Who was involved need to be there. The amounts need to be there. The year need to be there. The year needs to be there. And the type of transaction. These are, see, just saying that there was a journal entry passed, there was so and so transaction done, but what was the amount? Which was the entity? There was some transaction done. Who was the person who had authorized that transaction? So whenever we are drafting a certain observation, what is the entity what is the relation between the entity? Which year are we talking about? What are the amounts are we talking about? What is the transaction? Which books? What was the source of that identified evidence? So these 5-6 things, through a table, through a chart, if there are a lot of numbers, prepare a table, give background to that transaction, and then probably give an assessment of the transaction, that out of this, what do we think of has been the modus operandi. So that becomes the, again, heart of the report, where we identify and showcase the observations. Then becomes if there are any limitations and disclaimers, otherwise standard, the annexures go into the report, the glossary goes into the report. So this could be the probable skeleton of a standardized report, where we include anything from bank statements which are reviewed, to any digital evidence which is reviewed, any public domain observations that are there. So have to be reported, but as such, we have our own freedom and our own professional creativity to present it in a best possible manner, that the transactions at the end of the day are understood by the other. So I hope this answers. The third is test of nexus between parties involved. Correct. So as we were saying, a lot of tests can be undertaken. When are the transactions done between two parties? What is the timing of those transactions? Where is that entity located? Is there, who are the directors? Who are the shareholders? See, directors are easily available in the public domain. The shareholders are not. But we can download the data from the public domain source and understand who are the shareholders, who are the related party of that related party. So it might so happen that that entity might not be potentially vulnerably related party directly to the entity we are targeting, but its related party is somewhere related to the promoters of our entity that we have as target. So location, financial statements, anything and everything to do with public domain, promoters, shareholders, related parties. What are the common vendors? What are the common customers, if there are any? Which is the sector in which they are working? Forward, backward integration, same industry, competitors, non-competitors. These could be the possible tests to understand if there are certain related parties which are not reported, or there are certain undefined sort of related parties. So that could be one that I hope that answers. Timestamp test for different processes. Correct. So timestamp test, I think this could have been the answer for the non-unconventional techniques that we had on the screen. But I think this is more of an answer to an unconventional technique than a question. But yes, timestamp. So as we were discussing, the quotes are coming in for a specific procurement, and is there a timestamp to those quotes? Tenders which are being submitted, can we analyze those? Is there any trend that the person who is being last submitting the quote at the end is being awarded the contract? See, the perpetrator of the fraud is smart enough to not do that. Otherwise we would catch hold of it that every time the person submitting the quote at the very end is being awarded the contract. So what do we then go? See, point number 3 and fashion are somewhere related. Then can we go on to see some other trend? Then what we are observing in one of the cases is the third last or the second last vendor is being awarded the contract. Then we find the nexus between the third last, second last, and the last. So we understand that the last and the second last were a mere formality. There was a collusion. So timestamp test does help, and this was one of the examples that I could give. I think Jadipji, these were the questions, and
Yes,
if
sir.
there is anything else we can answer, or else I'm done
Yes,
from my side.
sir. Few more questions. Let me put you.
Yeah, please. Sure. I think before the next, until the next speaker joins, we have some time.
Yes. You can just wrap up on immediate or in speedy manner.
Okay. There is no much opportunity. Okay, next speaker has joined. Should I take the questions or answer offline otherwise? See, I can quickly answer. See, if the small players are having lesser opportunities, so we will have to take some kind of exposure by taking on ground jobs, or taking up some assignments with the people who have the assignment, and then take these kind of engagements. That could be one. Please suggest some courses. So see, our institute offers the certificate course. Our institute offers a certificate course. Lot of e-learning platforms offer certificate courses. There is certified fraud examiner. So this answers the second and the third question. Last question is what outcome to expect after reporting a fraud to top managements. Okay, so that depends a lot on the policy of that entity. What are the repercussions and what are the implications stated in the policy? According to the policy, the management would act. If it's an internal fraud, it's at the end of the day prerogative of the management to take the decision and not the regulators. Apart from what is there in 143.12 of the Companies Act, it stays internally as per the policy of the management. I think I'm done. Thank you so much. I will not waste time of the next speaker. Thank you so much, Jaideep ji, Shalini ji, the committee, Adukia sir for having me, and all the participants. Thank you so much. It was my pleasure.
Thank you, sir. Wonderful session, and time is short, and I would like to introduce our speaker for the second session, CACS Mukesh Dut, on the topic of expanding globally by overseas direct investment and applicable FEMA regulation. He is CA and CS, having 15 plus years of experience in banking sector, specifically FEMA domain. He is in service, currently working with Citibank Bangalore in the bank's global digital segment, commercial banking, which caters exclusively to startups. He has worked in the FEMA regulatory unit in the bank and thus got the first-hand experience on FEMA cross-border transaction, including trade and capital account. He has got external certification as well on trade finance from Institute of Banking and Finance UK. Apart from taking sessions internally in the bank, he has taken more than 50 knowledge sharing sessions on FEMA with external law firms and CA firms across in last 4 years. Now I would request CACS Mukesh to take over and carry on. Thank you.
Yeah,
Mukesh.
hi. Thanks, Jaideep. Thank you, committee members. Thank you, Rajkumar sir, for organizing and getting me this opportunity that I'm here.
Mukesh, you can.
Sorry, am I not audible?
Yes, sir, you are audible.
Okay. So thanks, Jaideep, and thank you all committee members. Thank you, Rajkumar sir, for this opportunity and organizing this session. And thanks each one of you for joining this session. And it's a great pleasure that I'll be sharing my perspective on FEMA regulations, especially the regulations applicable for overseas direct investment. Jaideep, you will be sharing the presentation here?
So you please share your screen and share the presentation.
Okay, 1 minute. Okay, I'm just opening it. Okay, I have just connected the presentation also. I hope everyone can see it.
Yes, sir.
Okay, so as I said, today's topic will be covering about the key provisions related to overseas direct investment. So as we all know, foreign exchange transactions currently in India are subject to Foreign Exchange Management Act 1999, which came into effect from year 1999 when government replaced or introduced this FEMA regulation, FEMA Act, by replacing FERA. So prior to FEMA, it was FERA, Foreign Exchange Regulation Act 1973, which was to be complied with while undertaking any kind of foreign exchange transaction. Now, just to understand what's the kind of difference or what the FEMA brings in addition to what was there in FERA. So in the course of FERA, as we see that FERA normally the focus or the objective was to kind of conserve foreign exchange, and I mean it was with a view to ensure that the limited foreign exchange resources in the country are kind of say spent only with prior approval of the government, so that there is best possible utilization of the resources. And given the situation at that point of time, FERA was rightly carrying out its objectives. As economy progressed, and since 1991, with introduction of Industrial Revolution, a need was felt to liberalize this regulation, and hence government brought in FEMA regulations with a lot of liberalizations and powers extended to the AD banks to permit transactions wherever they are satisfied basis their review of the genuineness of the underlying business transaction, they can permit. Additionally, FEMA brought in the concept of current account transaction and capital account transaction, which was not so in case of FARA. So here, what government has done is that they have clearly defined in terms of what kind of transactions the foreign exchange is available or is can be released and utilized, and what all kind of transactions will require, say, prior approval, and what all things banks or the corporates have to comply with while undertaking any kind of foreign exchange transactions. So most important or the key change is the introduction of the concept of current account transaction and capital account transaction. That was brought in FEMA as compared to FARA. Now, very, very important that before we can apply any specific regulation for any foreign exchange transaction, we must understand that whether the underlying transaction is a capital account transaction or a current account transaction. A very much clear definition is given in FEMA of what is capital account transaction. A transaction which alters assets and liabilities abroad in case of a person resident in India is a capital account transaction. Similarly, a transaction which alters assets and liabilities in India in case of a non-resident. So for example, let's say an Indian company is looking at investing into the shares of an overseas company. That means Indian entity is creating asset abroad. So it's a capital account transaction. Similarly, let's say Indian company is taking loan from an overseas company. So Indian company creates a liability abroad. So it's a capital account transaction. It's an ECB, external commercial borrowing. Similarly, let's say Indian company wants to bring in funds by way of FDI, foreign direct investment. So what happens is that non-resident creates an asset in India. So that is also a capital account transaction. Now, in case the transaction doesn't fit into the definition of capital account transaction, that means there is no asset or liability creation. That means it's a current account transaction. So a simple definition is given under FEMA. A transaction which is not a capital account transaction is a current account transaction. So a few examples could be, let's say a company wants to pay towards the services availed from an overseas company, say consultancy services. Then it's a current account transaction because it's just an expenditure item for which payment needs to be done. Similarly, let's say an exporter wants to send goods outside India and receive foreign exchange towards export proceeds. It's a current account transaction because after delivering the goods, what the exporter gets is the export proceeds and the transaction is over. So there is no asset liability created or pending. So it's a current account transaction. So very, very important that before we can apply any specific guideline under FEMA, we need to understand whether the transaction is a capital account transaction or whether it's a current account transaction, and accordingly the respective guideline should be applied. Now, today's topic we are going to cover specifically the key guidelines related to overseas direct investment, how an Indian company, when they set up a company abroad, what all things Indian company has to comply with. So all those regulatory aspects we'll cover above. Now, under overseas direct investment, basically we need to understand here the concept of strategic investment and the portfolio investment. So every investment that goes from India would be into, say, shares or say debentures or say some debt of overseas company. Now we need to understand whether that investment is giving any kind of strategic interest to the Indian investor or whether it is just a normal investment like say you and me investing into shares of say Google or Facebook, right? Our motive is to of course just invest into the shares of those companies, hold on it for some period, and if the price increase, we might want to book the profit and exit, or we may want to retain with a view to earning dividend on the investment. So it's a portfolio investment. But in case the motive is to do a business abroad, for example, a company creates another company abroad, or say company buys out an existing company abroad, that means what they are doing is that they are not doing a portfolio investment. What they do is that they invest into a company with a view to carrying out a business abroad with a view to earning business revenue. So that means motive is not a short-term motive. Motive is to kind of expand globally. Motive is to kind of take the Indian business abroad and get a market share from that in that overseas country as well. So very, very important, because the respective guidelines under FEMA varies if it is a portfolio investment or whether it's a strategic investment or the overseas direct investment. So whenever there is an investment transaction, we need to make sure that it meets the requirement of whether it's a portfolio investment or whether it's a strategic investment. If it is a strategic investment, then only the respective guideline for the overseas direct investment is applicable. In case of portfolio investment, there are different regulations. Now, and again, this is not something like a bank or the CA can understand. Rather, company only will be able to understand what they are doing. So whenever let's say the client engages with a bank or with the CA, it's up to the client to explain in terms of what is the nature of investment. Basis then only we can apply the respective regulation. So client needs to share what is the motive of investment. If the motive is to invest into the shares of the overseas company with a view to earning business revenue, with a view to do a business abroad, then it's a overseas direct investment. If the motive is to just hold the shares for some period, and if the value increases, exit from that investment, then it's a portfolio investment. Now, once classified that whether it's a overseas direct investment or whether it's a portfolio investment, we need to then accordingly apply the respective guideline. So here we are going to discuss about the key regulations applicable with respect to ODI remittances. Now, who can make this ODI investment? So it's not everyone that every entity is eligible to make overseas direct investment. So only certain categories are allowed, which is a company registered under Companies Act, a registered partnership firm or an LLP, or an resident individual. Only these three can make overseas direct investment under automatic route. Rest entities like say a trust, they would need RBI approval prior to making this investment. Now, in case of individual also, they can do only under LRS limit. LRS limit is USD 250,000 per financial year. Within that only, they can invest under ODI. So for company and registered partnership firm, there is different limit. It's not LRS limit, but the limit is they can invest up to 400% of the net worth as of the last audited balance sheet, or USD 1 million in a financial year, whichever is less. So we have to see that Indian company furnishes the balance sheet, and we need to check in that in terms of how much is the net worth of the Indian company to arrive at the eligible limit. Now, of course, from a guideline perspective, what the RBI has put in the guideline is that Indian company would need to certify this from its statutory auditor in terms of what is the limit Indian company has. And statutory auditor, of course, has to go through the audited balance sheet and find out the net worth component and calculate the eligible limit for the company. And it's a cumulative limit. It's not that if the Indian company is looking at investing into say 5 different companies, for each of those 5 companies, they get a separate limit. That's not the case. It's a cumulative limit across all companies, all put together. The overseas direct investment cannot exceed the 400% of the net worth as of the last audited balance sheet. And auditor has to certify. So there is a specific format given by RBI, which is part of Form ODI, available on RBI site. This has to be exactly certified in the same format by the auditor. Not only just limit aspect, even there are certain other clauses also which auditor has to certify in terms of whether the company is eligible under automatic route or not. So that's with respect to limit. Now, of course, there are various other conditions. It's like first remittance has to be towards equity only. Indian company can invest into an overseas company either by way of equity or by way of a loan, or even they can extend a corporate guarantee or bank guarantee to the overseas company. So all these put together forms part of the financial commitment, which has to be within 400% of the net worth. However, the condition is that first remittance has to be towards equity only. So Indian company cannot give a loan to a non-resident entity without having equity stake in the overseas company. And that equity stake also has to be in the nature of a strategic investment. Now, Indian company just cannot have hold some shares in the nature of a portfolio investment and then they want to extend loan to the overseas company. That's not doable. So Indian company can extend loan only if they have an equity stake in the overseas company. Second condition under automatic route is that Indian companies should not be having any investigation going on by any regulatory authority, be it say CIBIL, SEBI, or say from Enforcement Directorate under FEMA or any other regulatory law applicable in India. If there is any investigation going on the Indian company, then they are not eligible to make ODI investment under automatic route. They can apply to RBI, and RBI will approach that regulatory authority for a specific approval, and approval may or may not come, depends upon facts of each case. So if investigation is going on, or the company is under person list of exporters, then they are not allowed to do ODI under automatic route. Next condition is that valuation of the overseas company is required. So there may be two situations. One is that Indian company itself is incorporating the overseas company, in which case there is no requirement of valuation because company itself comes into existence post incorporation by the Indian entity. Second situation could be where, let's say, Indian company is acquiring a pre-existing company from an existing shareholder. Someone is owning or is already having a company abroad, and Indian company wants to invest into that company. Could be say 100% or some portion of the company. In which case, yes, valuation is required, and CA would need to certify the fair value of the overseas company. Now again, how much older the valuation certificate can be? Valuation has to be as of the transaction date. Many times we see this practical issue here, wherein companies like they have undergone a valuation, but due to some reason, let's say investment is not undertaken. Then say after 1 year, they want to do the remittance. So then in that case, again, it becomes that CA certificate produced by the company, whether the remittance can be allowed basis that CA certificate or not. So point is, as per the guideline, valuation certificate has to be as of the transaction date. So it cannot be say older than a reasonable period.
Can I take 1 minute, 1 or few minutes?
Yeah, sure.
Thank you, Mukeshji. Good evening, participants. I hope these Friday webinars you are enjoying. I just finished a council meeting, and God, I am of the strong view that God has given an ability to each one of us to be a speaker, to be a writer, to be a moderator. And if we look at, Jyot Pakshi, if you have heard his program today 4 to 5, and then Mukesh Doot. So anyone who is interested to be a thought leader means one who can who is seen and who is heard, then they can write an email to us. And webinars are every 4 p.m. to 6 p.m. 2 topics, and Saturday another committee, continuing professional education committee at the same time, like Jaideep has joined us from, to my memory, Nigeria. So I would request everyone, irrespective of where they are on this planet, they can come forward. And plus, we have other schemes where one can contribute in background material. And I can assure you there will be immense learning. And I will personally speak to the volunteer. We are very lucky that Madam Salini Gulati is a secretary of this committee, assisted by Madam Chanda Sukla, Mr. Krishnakant, Madam Reenat Taneja. Thank you very much. Mukesh, over to you.
Yeah, thank you, sir. Okay, so coming back to our session, with respect to this valuation certification requirement, the company is of course required to submit a valuation by a CA or a CPA of the overseas company whenever they are acquiring or investing into an existing overseas company. If they are incorporating their own company, then of course valuation is not required, but otherwise certification is required, and it has to be as That is as the date of transaction. It cannot be older than a reasonable period. Now, of course, the RBI guideline requires it has to be as of a transaction date, but at best it should be within a period of 3 months, not beyond that. Next condition is that overseas investment has to be into a bona fide business only. So, of course, the term bona fide business doesn't need a specific definition, but as we all know, what would constitute as bona fide, and that check needs to be carried out, understood well, and then only the transactions should be permitted. So it is the duty of the corporate to make sure that they invest only into a bona fide business. Next, APR reporting must have been filed. So whenever there is an overseas direct investment, there is a requirement of an annual performance report to be filed on an annual basis for each of the overseas JVs by the Indian company. So in case APR for any of the overseas company has not been filed, then in that case, Indian company is not eligible to make overseas direct investment in any of the other companies or even a fresh investment. So APR, very, very important that should have been reported to RBI by the due date prescribed. All the transactions in a particular JV should be routed through one and the same AD bank. So again, there's a condition that Indian company cannot have different AD banks for investing into the same overseas company. They can have different AD banks for different companies. So let's say an Indian company is having 5 overseas investment in different countries. They can choose separate banks for each of those overseas investment. But all transactions relating to one particular company have to be routed through the same bank, so that that particular bank has complete visibility on the underlying transactions of that company. Next, whenever there is an investment, the first transaction, at that time, UIN is sought from RBI by reporting the same online to the RBI by the respective AD bank. So second and the subsequent transaction cannot be allowed without UIN number. So UIN number is a must requirement, and it must be quoted in all future transactions for that particular company. Now, for undertaking an overseas direct investment, certain basic documents are required, which is, of course, specific standard declarations. Normally, all the banks ask for a particular document in their standard format, which wherein the company is required to kind of confirm that they comply with the automatic route guidelines, and they give certain declarations about the investment they are doing and about the kind of limits, whether they are eligible, whether they have any caution listing, whether they are under any kind of investigation, or whether they have any exporter caution coverage in exporter caution list, or also an undertaking that they will complete the reportings within the timeline prescribed. So a standard declaration is always usually taken by all the banks. Then auditor certificate in the format given in Form ODI has to be given. Valuation certificate, of course, by CA, if applicable, is required. Then project feasibility report of the overseas company. The Indian company, when they invest into the overseas company, they need to, of course, carry out a business feasibility and attach that report also along with the documentation furnished to the bank for doing the remittance. Similarly, certificate of incorporation, MOA, and articles of association or equivalent document in the overseas country for that overseas company is required. So, certificate of incorporation is required so as to verify that the overseas company is indeed an incorporated entity, because ODI is not allowed in unincorporated entity. Similarly, board resolutions, and if it's an investment into an existing company, then share purchase agreement with the overseas seller is also required to be shared or submitted to the bank. This is that bank reviews the documents. If everything is in compliance with the automatic route guidelines, then banks can permit those transactions. Otherwise, a reference is required to be made to RBI with a specific deviation for approval. Now, of course, detailed justification would need to be given if there is any deviation to the automatic route guideline, and approval may or may not come. It all depends upon the facts of the case and merits with respect to the deviation requested for approval. And very important in terms of what all sectors the overseas investment is allowed. Now, in case of FDI, we all know that there is FDI policy. Similarly, in case of ODI, what government has given in the guideline is that other than estate or banking sector, ODI is permissible in all the segments as long as it's an investment in bona fide business activity. And if the investment is into financial services sector, then yes, additional approvals are also required from the financial regulator of the host country. Like we have SEBI in India. Similarly, respective regulatory authority has to approve it. Next, as I said, the investment has to be within the 400% limit. That investment or financial commitment comprise of basically equity shares or say CCPS, compulsory convertible preference shares, or say non-convertible preference shares, loans, or 100% of the corporate guarantee or bank guarantee. Now, if it is a performance guarantee, then 50% is taken into consideration for calculating this limit. So these all put together forms the sum total of the financial commitment, which has to be within the 400% limit. Now here, notable point is that in case of corporate guarantee can be issued on behalf of direct JVs or first level step down subsidiary. Beyond that, it requires RBI approval. So Indian company cannot offer a corporate guarantee from here on behalf of a second level step down subsidiary. Now, what could be the situation when a corporate guarantee is required? So, for example, let's say overseas company has applied to a bank for seeking a working capital facility, and that overseas bank mandates that overseas company or the borrower to arrange a parent guarantee. And parent being in India, parent can either send a corporate guarantee or parent can request the bank in India to send a bank guarantee. Now, if it is corporate guarantee, then corporate guarantee can be issued on behalf of direct JVs, direct joint venture or the wholly owned subsidiary, or the first level step down. Below that, it is under approval route. Similarly, if it is a bank guarantee, then bank guarantee can be issued only on behalf of the direct JV or the boss. For step down subsidiaries, even bank guarantee will require prior approval of RBI. So equity, preference shares, loans, and corporate guarantee and bank guarantee all put together forms the sum total of financial commitment, which has to be within the 400% of the last audited balance sheet's net worth. Now, here I have noted what are the obligations of the Indian entity that does the overseas direct investment. Once, let's say, AD Bank has permitted the transaction and remittance has been done, suppose that Indian company is required to ensure that they submit the share certificates for the investment done in the overseas company within a period of 6 months. So they need to ensure that they get the share certificates and submit a copy of the SAM to the AD Bank. If they don't do this, then it's a non-compliance and there can be say late fee or penalties levied by RBI. Secondly, if there is delay, definitely AD Bank has to report it to RBI, and RBI can take suitable action as they deem fit, depending upon the facts of the case. If there is genuine delay, then yes, RBI may consider it. Second obligation is that Indian company is required to repatriate all the receivables from the overseas JVs, like dividend, royalties, technical fee, technical know-how, etc. Whatever dues are there from the overseas company, all that have to be brought in to India within 60 days. They cannot remain in the books of overseas company unpaid to the Indian company. These have to be repaid or repatriated back to India within a period of 60 days. Next, Indian company is required to submit an annual performance report for each of the overseas joint venture or a wholly owned subsidiary by due date prescribed. So as I mentioned, if the APR is pending, then Indian company is not allowed to undertake any further investment in any of the overseas companies. Next, Indian company is required to report post-investment changes. If there are any changes in the overseas company, like once they have, let's say, set up the company, there is change in, say, nature of business of the overseas company, or let's say if they have created some another company below that, if they have invested into another step-down subsidiary, or there may be, say, changes in the shareholding. Indian company may be having, say, 60% investment, and later on they increase or reduce, or let's say there are changes in the remaining 40% among non-residents only. So change of foreign partner, for example. So all that needs to be reported to RBI within 30 days. Now, Indian company may also disinvest its stake in the overseas company. Disinvestment could be say 100% or could be say partially. In either case, disinvestment has to be reported to RBI. If it is full disinvestment, then this reporting needs to be completed to RBI and EVIN will get closed. If it is say partial disinvestment, in which case necessary reporting indicating the percentage change will need to be reported to RBI, and RBI will update those changes in the system accordingly, and Indian company's stake will, let's say, will get reduced. And yes, in terms of timeline, it has to be the proceeds of the disinvestment has to be repatriated to India within 90 days from the date of transaction. Indian company is definitely required to report the overseas investment in the FLA report, and FLA needs to be filed by July 15 every year. So these are the key obligations of the Indian company, which they have to ensure that all throughout the life cycle of the overseas investment, they comply with all of these. And if there is any non-compliance, then yes, it will attract the penalty provisions under FEMA. Now here I have just kind of noted certain procedural aspects for applying to RBI for a specific approval. As we see, there may be situation where, let's say, the transaction is not under automatic route for whatever XYZ reason, and if it requires approval, then it has to be sent to RBI for a prior approval. Now, of course, the application has to be well structured, should explain the deviation for which the approval is required. It should be as detailed and comprehensive and self-explanatory, so that the RBI official going through the case can understand it in one go. Idea is that there are not to and fro exchanges of queries and all. In order to make a one straight through submission, expectation here is that the application to RBI should cover all the aspects about the overseas company, and also specifically the deviation for which approval is required. So in terms of process, what happens is that Indian company has to, of course, submit the specific request letter along with all ODI documents to the ED Bank, and ED Bank normally, or of course, has to attach their own request letter explaining the facts of the case and justification about the deviation and their own recommendation as well to RBI. And basis that, then application once submitted to RBI may either approve the transaction, or in case they do not find it approvable, then they might reject it. In case of rejections, normally there may not be any rationale in terms of why it is rejected. So very, very important that a comprehensive and a self-sufficient, self-explained application is submitted to RBI, so that RBI has all the information at their perusal and they can dispose of the case accordingly. Here I have noted a few case studies regarding overseas direct investment. In terms of the practical areas which I have seen, I have noted a few case studies here. For example, can an Indian company convert loans into equity and vice versa? So as I mentioned, in financial commitment, there could be an equity, could be a loan, or could be a guarantee. Now what happens is that, let's say Indian company has given loans, and instead of bringing it back, let's say Indian company wants to kind of increase its stake in the overseas company by way of equity. So instead of kind of bringing money which is already sitting in the books of the overseas company as a loan taken from the Indian parent, Indian company might want to convert that loan itself into equity. So whether that conversion is allowed or not. So yes, loan can be converted into equity. Our only requirement is that we have to see that Indian companies is still eligible under automatic route. I mean, it's not happen that this conversion bypasses the any requirement of the automatic route regulation. So here, additionally, one is that valuation certification would need to be seen of the overseas company, that overseas company's valuation is carried out and the CA or the CPA does that valuation, and a copy is submitted to the ED Bank. Rest, all other conditions like Indian companies should not be having any investigation going on, or should not have any appearance in the cautionless stock exporters circulated by RBI and all that. So all automatic route conditions would continue to be applicable and would continue to be ensured. Next, can an Indian party utilize the net worth of the Indian subsidiary or a holding company for investing into a JV or WAS abroad? So here basically, as I said, the limit for investment in ODI is 400%. Now there may be a situation where, let's say, Indian companies' limit is say exhausted or not sufficient. Then RBI has given one provision in the guideline is that they can look at utilizing the net worth if unutilized by its Indian parent or its another Indian subsidiary. In which case, that particular Indian parent entity or the Indian subsidiary whose net worth, unutilized net worth, Indian company is using, that Indian parent or the subsidiary entity has to, of course, give a disclaimer that they have not utilized that much portion of the net worth. Secondly, there is also the equity holding criteria that Indian company must hold 51% direct stake in the Indian subsidiary, in its subsidiary whose net worth they want to utilize. Similarly, if the Indian party wants to utilize the net worth of its own holding company, then that holding company must hold at least 51% in the Indian party. So if there is 51% criteria is met, and if the disclaimer letter is given by the respective parent company or the subsidiary company, then yes, net worth of that company can also be utilized. And company would have to ensure that that much net worth, I mean, those respective companies, the holding company or the subsidiary company, they will have to ensure that that much net worth is not later on utilized or calculated by them for their own investments. They have to always make sure that this portion which they have surrendered to that particular entity is kind of kept out of that limit. Next, can an Indian party capitalize the proceeds of the exports to its overseas joint venture or the wholly owned subsidiary? Now, there may be a situation where, let's say, Indian company has exported to the overseas joint venture or the wholly owned subsidiary. And due to their own business arrangement, let's say they decide that instead of bringing the export proceeds to India, they might want to convert that export proceeds into equity. And that way, Indian party increases its stake by way of equity in the overseas company. So that is also very much permissible. However, important condition is that it has to be done within the timeline prescribed for the realization of the exports. So currently it is 9 months within which the export proceeds should be realized. Then accordingly, within a period of 9 months, if the capitalization happens, then it can be undertaken. It is doable. But beyond that, if it is an export bills which has become overdue, then yes, company cannot capitalize that, and they will have to kind of send a press remittance from India towards equity. Next, valuation certificate, up to what date is acceptable? So as I mentioned, valuation certificate has to be as of the transaction date only. It cannot be older than a reasonable period. Normally, it should not be older than 3 months. Reason being, if it is a much older certificate, there quite possible that valuation of the overseas company has undergone a change, and hence it is not permitted that transaction can be undertaken using a dated valuation certificate. Secondly, in case of ODI transactions, there is no, while we take the valuation certificate, however, it's not like FDI, where we, in case of FDI, we know that investment has to be complying with the fair value criteria. Like when you bring in FDI, it has to be at a price more than or equal to the fair value of the overseas company when you bring in FDI. But in case of ODI, that fair value concept is not there. Our requirement is that valuation should be in place, and it cannot be dated or older than 3 months at best. So from a guideline perspective, it has to be, of course, as closest as the date of transaction. But normally banks accept up to 2-3 months time. Different banks may have their own internal guidelines, but normally 2 to 3 months is normally acceptable. Next, Indian entity invested in an overseas concern which has or will have FDI into India. Is that allowed? So here what happens is that, let's say Indian company has invested into a company in Dubai, and from that Dubai company, let's say there is an FDI into India. So the structure is that there is ODI from India, and then from that overseas company, there is further investment into an Indian company. So that kind of a structure is not permissible. Reason being, it amounts to round tripping of funds. Now there may be a genuine situation also where, let's say, Indian company has done the overseas investment, and that overseas company is already having a subsidiary in India. So Indian company might say that it's not that their money has gone and come back. That's not the case, because overseas company was already having their own investment into India. So even though there is a pre-existing structure, then also Indian company is supposed to have declared that structure and should have taken a prior approval of RBI while doing overseas investment from India. So Indian company cannot invest into an overseas company which has a FDI lag in India. Similarly, let's say when Indian company has invested into the overseas company and in future they want to acquire or invest into another company, that also is not allowed. So pre-existing structure as well as future structures, both will require prior approval of RBI. Now there may be a genuine case. For example, let's say overseas company, by way of their geographical presence, they want to have a small minuscule stake or investment into India. They want to have an FDI entity set up in India, which is say hardly 1 or 2% of their overall balance sheet size. In which case it may be a genuine case, but yes, it will help as a good representation to RBI to get the approval. But in no way it is still doable under automatic route. Even though it is say only 1% or less than 1% stake of the overall balance sheet size of the overseas company that comes to India as an FDI, then also this will require prior approval of RBI. And as of now, I have not seen a single case where RBI has approved it. We have seen cases where RBI has advised to unwind such structures and has also penalized the companies which have undertaken such structures, whereby they kind of have entered into these structures, which amounts to round tripping of funds. And recently, or maybe around 2 years or so, RBI has also clarified this in the FAQ also, wherein they have clarified this that such kind of structures will require approval. So yeah, these are the kind of key regulations I could cover, of course, in this limited framework of time. And to share with you now, RBI is also working on to kind of upgrade or revise the guidelines with respect to ODI. Last year, I think 5 months ago, they issued a draft guideline also, and they might come up with a new guideline soon, maybe say next 3 months to 6 months timeline. We expect another set of guideline wherein they are making certain changes to align it with the NDA regulation. As we see in case of FDI, similar concept is being brought in case of ODI also. So that's the key change. We expect that we will see that the new guideline might come up and will replace this existing regulation, which is FEMA 120, dealing with FDI, dealing with ODI related regulations. So yeah, that's the key regulations that I have covered and wanted to share with all of you. Any questions are there? We can of course take up now.
Yes, sir. We have a few questions, which I am putting in your chat box.
Okay. You will read out the question because I can't see it.
One second, sir. Whether FLA has to be filed by only corporate investor or individual resident also need to file FLA?
No. So FLA is not by individuals. It is to be by corporate and LLP only.
Okay, sir. Can CPA from the country where investee company is located issue valuation certificate?
Yeah. So either an Indian CA or a CPA, either of them can do the valuation.
Okay.
And there is one more provision. If the investment amount is USD 5 million or more, then valuation has to be done by a SEBI registered merchant banker.
Okay. Any further question, Chanda madam? Any more question? I think there are no questions as of now. And if there are questions, then participants can contact Mukesh ji on his contact number shown on the screen. He had yes.
Surely, I mean, if anybody has any questions or need any clarifications, can reach out to me through WhatsApp or through a phone call. That's absolutely no problem.
Yes, we had a very wonderful session on 360-degree view of forensic accounting and investigation and expanding globally by overseas direct investment and applicable FEMA regulation by CA Jyot Bakshi ji and CA Mukesh Doot ji. I hereby thank you, both of you, on behalf of committee and all the participants. Thank you, sir. Thank you.
Thank you.
Thank you so much. Thank you.